welcome everyone. My name is Abhi Kane. I'm a head of investment research at SkyBridge Capital, and I will be moderating this panel. Whenever you hear a panel titled regulatory change or impact of regulatory change, you typically lose half the audience. Then when you start digging deeper, then you talk terms like Dodd-Frank rule and large-scale asset purchases, you lose the other half. But hang tight. Our panelists here have made, they have not only been ahead of the curve, but have made several hundred millions of dollars, if not billions, for their hedge funds because of these very regulatory changes. I'll start with questions, then move on to, I'll start with introductions first, move to questions. Then if we have time, maybe we'll take one or two audience questions. Let's get right to it. Now, if there is one fund that has made a name for itself on staying ahead of the curve as far as regulatory changes are concerned, it's EJF Capital. SkyBridge has been invested in EJF since 2011. I think the EJF investment team is top-notch. They've been ahead of the regulatory changes, and they've not only been ahead of them, they've found unique ways of implementing their trades, which is what I like. So I want to start with Heather. Heather, please tell us about EJF and your role there.
Sure. EJF Capital is about a 15-year-old firm, and we are unique in that we're based in Washington, D.C., which does put us in the middle of the political and regulatory changes that are happening. We are a financial services-focused firm. We invest in both debt and equities of those types of companies. And we have 85 investment professionals, 30 on the portfolio team with about $10.5 billion in assets under management. I've been with the firm now for 6.5 years, and my focus is on sourcing new issue bank subordinated debt and then executing the securitizations for those securities.
Okay, thank you. Angelo Gordon is a relatively new investment for us at SkyBridge. But TJ here has done such a good job that they have fast risen to be one of our top 5 positions. So I welcome TJ Durkin from Angelo Gordon.
Thanks, Abhi. Angelo Gordon is a 30-plus year alternative asset manager where we focus exclusively on credit and real estate. We have about $35 billion of assets under management. I've been with the firm 11 years and run our structured credit business.
Thank you. There's a lot of managers in the agency mortgage space that have either retired or closed shop in the last 2-3 years. So we at SkyBridge, we're on the lookout for a young, new, energetic manager to look at this sector with a fresh lens. And I think we found a perfect candidate. Please welcome Adam Rilander from Galton Capital.
Thank you, Abhi. So I work at Galton Capital. Galton has a 10-year track record, has about $2 billion under management. We focus on consumer credit and agencies, roughly split 50-50. We're part of Mariner Investment Group, which has $10.5 billion and a 25-year track record.
Thank you. Now, CQS, obviously everyone has heard of CQS, and it's a relatively new relationship for us at SkyBridge. And I'm hoping Jason here will follow TJ's lead and put up some good numbers, and I don't see any reason why he should not be in our top 5 positions. Please welcome Jason Walker from CQS.
Okay, thanks, Abhi. Yes, CQS is a global asset manager. We have about $18.5 billion under management. I'm co-CIO of our ABS strategies. Again, following the same format. We're globally based, so the team's split between London and New York, and we run about $5.5 billion of ABS assets, the main one of which is our global ABS hedge fund, of which Abhi spoke so kindly.
All right, thank you. Now I want to start with Heather. There's one sector that has been the epicenter of this drama of regulation, deregulation. That would be the US banks. Now, we have 5,000 plus banks in the United States. We have way too many banks. We have one bank for every 45,000 people, whereas in the UK, they have one bank for 450,000 people. Now, not that UK is the gold standard of banking, but the point is that there's way too many banks in the United States, and that sector needs to consolidate. So I want to call on Heather to explain to us what's happening due to Dodd-Frank rule and the exciting opportunities that are coming out of that regulation.
Sure, we're still experiencing a lot of positive benefits from the 2018 regulatory relief bill that was passed on a bipartisan basis back in May of that year. One of the main themes that we've been focused on is the ability for banks to, especially the smaller banks, 97% of the banks in the United States have 10 billion in assets or below. And the regulatory relief bill was really targeted for those type of institutions with the idea in mind that these institutions do need to consolidate to gain economies of scale to really be competitive and produce, strong profitability numbers. Our thesis there continues to be we buy equities, but we also buy the debt securities on a new issue basis, and then we look to securitize those.
Excellent. Now, everybody's heard of The Big Short. A lot of investors made a lot of money betting against the US housing market. Movies have been made about it, books have been written. I'm sure there's a course at NYU Abu Dhabi just focusing on The Big Short. But what's lost in all this is the story of the big long. Investors have made a lot of money buying those same subprime bonds that John Paulson shorted in 2007 and as the housing market recovered. I'm sure if there's a movie made on the big long, TJ here would be its star. So TJ, please tell us your experience on investing in subprime market.
Yeah, I mean, as Abhi mentioned, I think everyone knows the story of how we got to where we got to the global financial crisis. But the market structure then versus today is much different. Then it was much more a case of a ratings-based investment process. You had a lot of highly levered investment vehicles, SIVs, asset-backed paper conduits, et cetera, that were really relying on, Moody's or S&P saying something was AAA, and then the assumption was that housing in the U.S. could never go down in value, and obviously we learned the hard way that that's not the case. And so coming out of that was you had a huge amount of forced sellers that really owned paper based on ratings. Performance deteriorated, the ratings got downgraded, and there just wasn't enough capital, in the periods of 2009, 10, 11, 12 to really absorb all of that. And so prices adjusted down accordingly to where it would clear. And, folks like ourselves, that really went into the process with more of a data-driven loan level analysis to understand what credit we were buying. We're able to take advantage of that versus the original buyers that were a bit more nascent in their underwriting.
Now, they say when the Federal Reserve started cutting rates 10 years ago, nobody tweeted about that on their iPhones. Why? Because there was no iPhone and there was no Twitter. So we've come a long way from there. And since then, investors or people world over have been barraged with what the Fed is doing. There's blogs written on it, there's tweets, there's social media everywhere just like saying what the Federal Reserve does and doesn't. So we have a millennial here who apparently makes sense of all this and puts on good trades. So I call on Adam to explain to us what's happening in the agency mortgage land and the impact, especially the Fed is doing on what you focus on.
Thanks so much, Abhi. So yeah, I think that one of the most underappreciated things going on right now is the Federal Reserve's change in what assets they've held. If you look backwards to how they grew their balance sheet from 2009 through 2015, what was quite interesting was they were really focused on agency mortgages and were really successful in driving down mortgage rates, which was the goal. Mortgage rates blew out after the crisis in 2008, but the Fed came in to really save the market, bought a ton of mortgages, and got up to $1.7 trillion by 2015, 2016. What's going on right now, and really started in 2017, was they started to unwind that portfolio. There's been a lot of talk about taper and how the Fed had been shrinking the balance sheet starting in 2017. But most importantly, even as they ended taper right now, they're still shrinking the agency mortgage, their agency mortgage positions. So what's happened over the last 2 years is agency mortgages have widened by 40 basis points, while almost all other forms of debt, like investment grade debt, have tightened significantly, high yield has tightened significantly. Basically, everything up in the capital structure has been tightening, while these AAA assets have been widening, mainly because the Fed's been selling. And we expect that to continue over the coming 10 years or so, which should be a really interesting opportunity going forward for agency mortgages and all the derivatives based off of them.
Now, one of the most bizarre phenomena of our lifetime, or any lifetime, is the phenomena of negative interest rate. How do you take out less money from a bank on the Friday that you deposit that very Monday? Well, we have Jason here to tell us an investor's view of this phenomena, and also the fantastic trades he's been finding to stay ahead of the game and even make money despite the negative rates.
Yeah, I mean, it's been an interesting backdrop, and especially, given our kind of position in both the kind of US and Europe, and looking and comparing kind of the different timing of what central banks have been doing, et cetera. I mean, looking at Europe specifically and taking one kind of key example, obviously where we have kind of clear negative rates from the ECB for quite a prolonged period. In European CLOs, for example, it's quite interesting to think about the mix of the assets, but then also compare the financing as well, because there's really different kind of dynamics between those two different subsets of the market, if you like. So in European CLOs, quite often the majority of those assets actually benefit from Euribor floors. So, whilst we've been having kind of those gyrations in rates on a negative basis, actually there's been quite a bit of value actually building up of that value of the floor, if you like, because the rate, the kind of benchmark on those CLOs with Euribor floored at 0. Obviously that's even more valuable further up the capital structure, as it's a larger proportion of the overall kind of spread of those tranches vis-a-vis the more junior pieces. But nonetheless, on a relative value basis, when you can kind of compare that across other sectors, which may not benefit from floors even in Europe, and then to global sectors, that's an interesting comparison. If we then overlay repo finance to that, when we go out and we maybe buy a mezzanine CLO position, we're benefiting from the floor on the asset side. But if we finance it, actually we get the benefit of the negative rates. So every time you kind of turn that, kind of put an additional turn of leverage on that asset, you're kind of been able to lever that negative profile as well. So it's quite an interesting setup, and a phenomenon that may or may not last for a bit longer.
Get paid to borrow, that's a good word. All right, I want to go back to the banking sector again, and there are similarities between the US banking sector and European banking sectors. And talking earlier, I know Heather has, basically EGF and CQS have different ways to go at the same phenomena. So I want to start with Heather and what you're doing in European banking sector.
Sure. To just take a step back for a second, on the US side, we were probably one of the first investors in 2013 to start purchasing new issue subordinated debt from banks, and it took some education and a little bit of time to get investors, to get banks sort of comfortable with issuing this type of security. Even today, banks under 10 billion in assets have 90+% of their balance sheet in equity versus optimizing it more fully with debt. We think we can take the same strategy we started with in 2013 to Europe today and be that first mover in finding, we think there's probably like 5,000 banks over there that can take advantage of some of the new rules that are coming out of Europe with CRD4 and Pillar 2 to uses them, the Tier 2 capital to optimize their balance sheet and raise capital more efficiently.
Yeah, absolute variation on a theme, and certainly that can focus on the banks and regulatory capital has been, ongoing for some time. But as we're coming to kind of more concentrated look, if you like, as Basel IV in terms of that implementation period, kind of 2022 through 2027 actually comes into focus. And then also if we overlay, there's actually a bunch of accounting rule changes as well, both in Europe and the US, actually, IFRS 9 and the CECL, current expected credit loss regime coming in January. In the US, which from a provisioning perspective is achieving some of the same kind of focus for the banks with regards to holding capital against some of those assets. So what we've been doing is looking at bank regulatory capital transactions. The distinction I would draw there is that, we were just talking about CLOs, and that's a good comparison, obviously a pure kind of arbitrage trade on the CLO side. Bank regulatory capital deals should be, and the onus is to check. These are, we view these as more kind of aligned kind of, kind of risk-sharing transactions, we would term them, as opposed to arbitrage trades. So what we're looking at there is core assets of banks, assets that they are kind of material kind of market leaders in, that they're going to have ongoing exposure to the sector and to the names, and whereby we can actually work with them, understand their business, their underwriting, and essentially kind of invest alongside them. And then they get the benefit of regulatory capital relief on the back of that. And the exciting thing is it's a big period of evolution for that market. It's traditionally been kind of just a European bank market, but we can see it, because of some of the new rules, the nuance of Basel IV, increase the number of assets that are going to be used. So it could be mortgage assets, autos, et cetera, as opposed to just corporate risk, which has been the mainstay, but also pushing into the US, as I mentioned, those accounting rules earlier. So a sector of evolution, and kind of an interesting comparison to general ABS sectors as well.
Going back to the USA, there's a new Mason-Dixon line in the mortgage market. It's called the qualified mortgage and non-qualified mortgage. And TJ here can explain some of this and what he's finding in that market.
Yeah, I think it's fair to say, if you were to say the mortgage market caused the previous financial crisis, it was now pivoted to Dodd-Frank and other things, sort of over-regulated it. And so now we sit here 10, 11 years later, and I would say mortgage credit availability in the US is extremely tight in comparison to, say, corporate lending. And so there's, obviously the two behemoths of Fannie and Freddie that still control a large majority of the market share, which are, government-sponsored entities at this point, and still in conservatorship. And then there's the mortgages that don't qualify for that standard. And we would say that there's a lot of opportunity in that non-qualified mortgage space to get really high-quality credit loans that aren't fitting that box. And so, over the last 12 months, we've purchased approximately $1.5 billion of non-qualified mortgages. We do use securitization to finance them, and we think that market will continue to grow. There's a high barrier to entry in terms of buying raw whole loans versus securities, and so I think you need to find shops that actually have that infrastructure, whether team operations, due diligence capabilities. So we like that there's some barrier to entry from a competitive point of view. And I think what a lot of, at least what we're thinking about, and I know there's a lot of talk about sort of the GSE reform and what happens with Fannie and Freddie, and we don't really have a stake in that game, but I think it's fair to say that they want to reduce footprint, and so that'll create different opportunities for Adam, but where for us it creates, if the new game plan for Fannie and Freddie is to say, you know what, they shouldn't be financing investor properties or second homes or allow cash out refinancings, that's a huge part of what their market share is today. And so, if you look at just 2019 mortgage originations, those three things which would qualify for a reduced footprint is about $300 billion of issuance. And so if that huge amount of mortgage credit has to find its way to the private market, it should present immense opportunities for people like ourselves to use our pipes and infrastructure to go supply capital into the mortgage market at what should be, I think, substantial risk-adjusted returns, given I think there'll be a bit of a mismatch on capital needed versus capital available.
Thank you. So I don't think 10, 12 years ago anybody heard of FHA, Federal Housing Authority, or its authority, FHA. We've been through the crisis with 8 million people ready to hand over their keys to the bank in 2008. We have less than 100,000 people now. And every day you open the Wall Street Journal, you'll see what's happening at the FHA and what they're doing and what they're not doing. And Adam can comment on some of the news flow that's coming out and what trades are coming out of that.
Yeah, so FHA and FHFA, which very similar acronyms. So as TJ sort of went through, I think that some of the things that are really interesting on the non-qualified mortgage forward-looking investment thesis is very interesting today in the agency mortgage thesis as to things that are going to happen going forward. So typically an agency mortgage hedge fund, what they purchase are IOs and inverse IO securities frequently, which are securities that benefit when prepayments end up being slower than expectations. And as TJ mentioned, a lot of what's going to happen in reform at FHFA, at Fannie, Freddie, and Ginnie over the coming years is shrinking the current 80% between Fannie, Freddie, and Ginnie of the footprint right now and shrinking that down closer to 50 or 60%. As they go ahead and do that, the only way to do it, such as some of the things that TJ had mentioned, such like shrinking investor loans, cash out refis, vacation homes, all of those things, the only way to reduce the government's footprint is to raise the mortgage rate that the government's willing to offer. In turn, what that will lead to is slower prepayments on all of those securities. Right now, I think that's a unique time to find some opportunities to buy something that really isn't priced in, because I think fixed income investors generally don't like to take risks that you can't see priced already. So I think what you're seeing is these bonds are relatively cheap, especially given what the Fed is doing. So you can find IOs and inverse IOs that are priced very fairly for what the market looks like today. But going forward, looking at what is likely to happen, and I think it's been relatively well telegraphed from the FHFA, you're going to see slower prepayments on a wide swath of the market, and end up seeing the bonds end up appreciating that exist currently today.
Excellent. Now we have some time for audience questions here. We can open it up for any audience questions.
Prompt Play, SkyBridge Capital. How are you? Thank you guys for being here. Actually, it's just an open-ended question, mostly for the United States market regarding student loan debt, and kind of goes under the radar a lot, especially after the Big Short topic and the mortgage crisis. There is an underlying debt problem, and students are really unsure of really what the value of education is. So I know it's slightly off topic, but since it is somewhat relative to regulatory reform, I thought maybe you guys have some ideas on just your initial thoughts on what could be the disruptor to that sector of the debt market. Anybody in particular?
I have a feeling you're going to point at me. Yeah, I mean, so student loan debt is a huge problem in the U.S. To put it in context, there's about $1.5 trillion of student loan debt outstanding. What isn't as well known or publicized is that about $1.25 trillion of it is sitting on the government's balance sheet, so the Treasury. So basically, they've originated the vast majority of vanilla undergraduate loans since 2010. So I think there's kind of the raw debt problem, but it really is a function of why is the cost of college or university in the U.S. so high. So it's part a financial issue, and then it's part like more of a social policy issue. And so even if you were to get a Democratic president that wants to forgive student loan debt, that's more of a backward-looking policy versus saying, well, what are the people in college going to do? Like, there's still a cost and funding problem. And so, in my opinion, and we spend a lot of time on this, we have exposures to some of the non-government student loans out there. There's not a lot of utility in forgiving the current debt outstanding if you haven't solved sort of the cost of college situation. And I think that's more of a political issue, which I wouldn't handicap them figuring out anytime soon. And so all that really does, all student loan really does, I think, for the folks on this panel is when we look at things like historical housing formations and metrics like that, which if you were supposed to get married and buy a house at 27, that's just been delayed. And so coming out of the crisis, I think we have the quote unquote millennials that are now getting to the point in the life cycle which, if looking backwards, they should have been at 5 to 7 years ago. So it's actually probably a positive in terms of the U.S. and sort of forward-looking GDP or consumption. But that's kind of the long and short on, I think, student loans from my seat anyway.
Yeah, I think the new household formation age is 32 years versus 27. So it's been extended by 5 years since the crisis. All right, so we're sitting here in Abu Dhabi, a lot of international investors here. Now, we know why we invest in your funds for low duration, higher yield, the recovery story, all that gels well from our point of view. But from an international investor's point of view, can you please tell us why they should invest in your strategies and what's the draw? Like, anybody can take it.
Sure.
You want to take it?
Yeah, I mean, I kind of think of our strategy as, I mean, an ABS generally as its own kind of multi-asset credit sector. So when we're looking, we try and look globally so that we can try and identify different drivers at different points for different markets. I mean, obviously there's been a lot of uncertainty in the global market, a lot of kind of barbell potential outcomes that still exist. Let's see what happens on the 15th, for example, on the 12th, the UK election, and so we go on. But I think from that kind of wide range of options, we can kind of select different profiles. And so we're seeking to kind of, find kind of lower correlation, kind of stable return profiles, and kind of create something that's, that's kind of all weather, if you like, that we can kind of balance up and be stable.
Yeah, I guess I would say, we have two main drivers in our funds, but number one, the consumer, sort of related to all of us, is a lot healthier right now than the corporate balance sheet right now. And I think in general, the next recession we think is likely to be driven more from the corporate side than the consumer side. So being in consumer credit is generally the right place to be right now. And on the agency side, I think it's sort of fascinating sitting in a position where the mantra always used to be, don't fight the Fed. And the Fed's selling all these agency mortgages. You're getting this really interesting opportunity on one side, where on the other side you have a regulatory body that's looking to shrink the Fannie and Freddie footprint. So there's lots of opportunities from a regulatory standpoint to sort of be playing both sides of that trade.
Yeah, I would just add that our markets are fairly granular in the underwriting process, and so they really haven't been what I like to call electronified. There isn't a huge ETF presence. There's no algo trading from the investment banks in our product. And so it just creates, I think, a better yielding, less volatile stream of returns than other asset classes.
Okay, good.
And I think from EJF's perspective, we have a core competency in the community bank space, and knowing, we invest, as I mentioned earlier, in both debt and equity, which I think is unique for bank investors in the space. And so we see a lot of opportunity in the market as the consolidation continues to play, and with our analysis to pick who we think are going to be the survivors and who are going to be the ones that are acquired, what gives us a real edge, and we've had strong returns that back that up.
Great. Well, good thing about Abu Dhabi investors is they are pegged to the dollar. So the dirham is pegged, so you don't have currency risk in this situation, which is not true for a lot of emerging market investors. As I said, yield, obviously, that's the biggest draw here. Dollar, the stable currency, and specialists in this market to navigate investors is very important. Now we have a minute left or so. The last questions I want to ask is, going forward, like these were termed as legacy securities, we're done, it's going to be cleaned up, there's nothing left. In 2-3 years, maybe we won't have a trade. Now what do you say is a counter to that in terms of the legacy securities? Anybody can take it.
Yeah, I mean, I guess there's I'll leave the US, some of the US mortgage market to these guys, but I mean, there's obviously innovation everywhere in terms of what's happening in CRT and stuff, but we've talked about reg cap risk in Europe, we've talked about, different asset classes coming through. I mean, there's a whole range of commercial, consumer and kind of mortgage assets that are evolving constantly. So I think, I think we see a lot of opportunity in the horizon.
Okay. Adam, anything?
20
seconds.
I think I think that the reality is that there's going to be a lot of CRT innovations right now. There's a lot of things that to be at the forefront of that are very interesting. Going back to the agency mortgage market, that's far from a sector that's going away. It might be shrinking from 80% to 60% of the mortgage market, but that's still going to be, many trillions of dollars.
Great. That's all the time we have for today. Thank you, everyone, and hope you're enjoying the conference.